Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, August 21st, 2025. It's 3:31 p.m. as I'm starting the video. Just give quick updates. Again, a reminder, fireworks may or may not start tomorrow when Powell does his speech at Jackson Hole, so the market's probably going to continue to grind around a little bit, little pre Jackson Hole volatility. Plus, we had the economic reports today. The technicals are what they are. As I mentioned earlier this week, we had some sell signals started to trigger on Friday with follow through early in the week when I got back from vacation. So it is what it is. This market has seemed like it didn't want to correct for ages, and maybe it's just a blip. But the day I stopped taking, high probability or reliable sell signals and buy signals is the day I need to hang this up. So I don't. Well, my point is, I don't second guess sell signals even when the market seems resilient. Now, with that being said, is it an all-in moment? No, for the reasons I stated. So again, since late last week and early this week, we had a decent decent evidence in a while to get short the indexes, primarily QQQ, my preferred index. On that, that just jogged something. I'm going to look at small caps for you too in this video, and then highlight just a couple other trade ideas. I got this one out to you. That post was posted earlier. I had taken some software updates to the site today, and I've been on the phone with my web hosting company on and off a few times today. Getting sometimes you get some bugs when you take software updates on a website. It's not just the website. There's a gazillion different subcomponents and sub software things, if you want to call it that, plugins and other things that run a website. So anywho, usually I do those on a weekend or after hours. I just had some updates pending that I just wanted to get done today. So again, pardon my dust. We were down for a little bit there, but the website is back and running. Everything seems to be working fine now. And you did get this trade idea out. This one did go out by email. Hopefully, if you're listening to my voice, you got this. But that's it. So untriggered, it's like I always talk about it, the difference between a trade setup and an actionable trade. Last trade idea was right here off this divergent low. We went up, we hit my first and second target, but natural gas reversed from there, never hitting these remaining targets. So that was a previous trade. Now, maybe a trade that you've stuck with. Again, everything is relative when you look at the potential in nat gas. There's a potential, kind of like wheat, things I've been talking about, commodities that are really, and they've been setting up for a while for what could be a big move. And I still think over the next year or so, we'll see outperformance in commodities relative to the stock market. And this is it. So it's an untriggered setup that you can see right on the line. And that's it. If it pops that level, especially a solid 60-minute close above it, that's a breakout. Big divergences, same divergences have been building since the last time, that last trade that was mentioned. They've just grown larger now. Just a quick update on natural gas. We had a monster trade, epic trade calling a low, going long natural gas here, and giving you guys targets that ranged all the way. Well, actually, I'm sorry, one final target. Once that trade started to get underway, I gave a final target just shy of the $5 level, zeroed in on that as being 490. And here, let me show you the chart. And so we exited that trade right here. It was a unique exit, but again, another one of many reasons why I like to trade futures, because that trade, as I took the screenshot that night, it was not reflected in the end of day chart on natural gas futures. These are nat gas futures continuous contract, but it's going to show you the regular hour of the regular when the contract closes. And so when natural gas opens on Sunday evening, just like stock futures, those aren't reflected, those trades, just how it closes that Monday. And so I gave a chart to you at that time on the actual futures, that current month's contract, and we hit my 490 target to the button. So again, it was a call of 200% gain off the lows to the very highs. And you can see I had a pullback coming down to this trend line. Now, I will say I slightly modded that trend line. Again, this is the chart I gave you back on March 9th. And there have been a couple in and out active trades, but this is where, based on that, because it was a final long-term target, but all along I give you a second potential if after a correction here, target up there about 650. And again, that goes back to March 9th. And so here's the current nat gas target. So again, I've a chart. I'm sorry. This is the uptrend line right here. Like I said, I've what I did is I zeroed in. I looked closer to the chart. I didn't have it exactly on the low, which we were long within basis points on that low, or a couple percentage points. Hit that next low right there, and this is the trend line that, again, when we were here, higher than this chart reflects. We're right exactly at my 490 level, the very high, and that's kind of again, just no guarantees, just based on my kind of read on the charts, had us coming back to this uptrend line. So I just wanted to say that we're there, and then this is still a potential longer term target, because remember, the whole basis for that trade in 2024, early 2024, calling for a 200% run, was based on that divergent low. For many years on this site, we've traded natural gas, and we've caught a lot of these, and maybe not everyone, but a lot of them we were long on or near these divergent lows. Again, this is my weekly chart, by the way, guys, not the 60-minute I keep giving you for shorter term swing trades. These are the trend trades right here. That's what a weekly chart is not used for short term swing trades. It's not used for day trading. It's used for trend trades. Some of you might call those investments. Trades that, at least on natural gas, are measured in the 100%, 100% or more. All the numbers are here: 230, 223%, 160, 230 something, 208, 563. That was almost 200% right there. And again, those are the trends. Now, where I'm going with that is, if this divergent low, which is bigger in scope, here, let me zoom in a little so you can see all of it. That divergent low that we put in when we went long back in 2024, you can see how powerful the divergence is. This is the most powerful divergence. Look down here at the PPO at the bottom. Look at the RSI. By far bigger than any of these other divergences back here in the past, right? And yet all of these average, again, 223, 160, 240, 207, 500 something. So is 200 it for that trend? I don't think so. So this is why I'm talking about natural gas right now. If it falls lower, maybe it goes here. But typically, once an uptrend gets going, as I often say, nothing goes straight up, especially primary trends. There are plenty of counter trends. Big enough, the corrections are big enough to make everybody think this natural gas is going to zero. That's the nature of this beast. It's the most volatile commodity that I know of. I call it the widowmaker, because if you're not managing stops properly, or your entries, or you're going too heavy on your position sizes, you're not going to be happy trading natural gas. Take in mind, if you're going for a 20, 30, 50, 200% run, you don't need to put a lot in to make a good amount of money. So it's all about, take your position size down to the comfort level, and that way you won't freak out when that gas is down 8% in a day. If you're targeting a 50% upside and your stop is 15, 16, 18%, whatever it is. All right, so that's that. Let's move on. So there's still very much the potential to have a move up here. I'm not measuring it, but I can just tell you that'd be more than a double, going from 275 to 640-ish. Oh, 640-ish. All right, moving on. Like any trade, it works, it doesn't work, take it, doesn't take it. It's also not a actionable trade yet. It is a trade setup pending a breakout that has not yet occurred. I wanted to update you on the NVO Novo Nordisk trade. Not by any means a monster trade, but when we hit the T3 level, my third price target, remember this was a bottoming play based on the long-term chart. Well, one of my favorites. I've been waiting for a long time for this stock to get down to this level. I had a pretty high degree of confidence it would. That is the primary bull market uptrend line. The problem with the trend lines, and even in bull markets, when you get crazy, think NVIDIA, think all this other AI crap that's just gone, parabolic. Gravity or natural market forces, whatever you want to call it, will tell you, even if the stock's if NVIDIA's got 10, 20 years of growth in front of it, let's say, some super duper secular bull market that's just going to go on for decades. Even if that happens, NVIDIA is going to periodically come back and visit its primary bull market uptrend line. And when it does, the farther it gets away from it, the more powerful the mean reversion or pullback to that trend line will be. So either way, Nova went there, as I talked about, down almost 70%, and very good price support, likely selling climax, positive divergence on the weekly. And again, I wouldn't be surprised at all if it retests the recent lows, and I wouldn't be surprised if it doesn't. The reason I wanted to give you an update, well, right now it's back down on there. It briefly entered the gap today. Remember when we hit T3, I told you it was the bottom of this massive gap right here, and that therefore a reaction is likely, and it very much was. So if you zoom in, right there is that candle right there. You can see the top at 55.41 where I had it. It pulled back, and it was about a 3% or so pullback. But so far, the reaction has been the more bullish of the two. I always say a reaction, I define it as the ping pong ball bounce or the hacky sack bounce. You drop those both on a concrete floor, ping pong ball will bounce, and the hacky sack will kind of just sit there, right? And so this one, the more bullish of the two, if it's, if it holds up, is a reaction, which we got, but more of a sideways reaction. It really came right up on T3 there. It's been 4 days sideways. We entered the gap today, but right now we're not in it. I just wanted to keep it on. Once it clearly enters a gap, stocks have a tendency, once a gap is entered, and there's your big old gap right there. It's not my right tool. This is the gap. They'll often backfill it. Now T4, I look at reaction lows as well. I'm not calling for, even my final target right now is not a full backfill of gap. The only way I think it's going to get there is if the stock market doesn't, crap the bed this year, which is still very much, I think, a possibility, but we'll see. I don't care. Trade long, short. I might talk about doomsday scenarios and economic recessions and all that, but I'm going to buy stocks based on the chart. And at any point in time, I think you'll struggle to find any period except those meltdown modes, 2008, 9, or, COVID, where, all ships are dropping, due to a strong correction, where you're not going to find, a combination of long and trade. I take that back. Even during bear markets and big corrections, I often then migrate over or include more and more things that do go up when stocks fall, such as various commodities, gold, silver, GDX, crypto at times. Again, at times. There are times, as I've pointed out, that the crypto is highly, highly correlated with stocks, typically on the risk-on markets, and there's times where it's not. The most recent was we were short crypto heading into the April lows, but before the stock market bottom, I made a point to get out to close out our Bitcoin trade. Told you that we were probably going to bounce, and I saw that relative outperformance where crypto was holding up, and IBIT was the proxy for it. It was right here. So we went from shorting crypto there. When T3 was hit, I said, T4 is on hold because I reversed everything, as I told you, all shorts from longs, and crypto as well, particularly because a very bullish chart. And so the market continued to fall, crypto was holding up, and you got that nice rally out of it. Now we've come full circle, big divergences building, and the next big move in crypto is going to be to the downside, as I talked about, and that's excuse me, a little technical glitch there. So Bitcoin is often, over time, just like gold, very much correlated inversely with the dollar. Not always. There are times of disconnect. So I'm still waiting to see the dollar take out my first price target. That's UUP. And again, Powell has the potential to make or break this. The charts tell me that's a likely scenario. I pointed out dollar bottoming here, went up, hit that first target, pulled back. So if Powell doesn't come out wearing his dove feathers tomorrow, but instead has his hawk cap on, with the little hawk bill or whatever, boy, that could send the dollar up, and then that would almost certainly be a bearish for gold, bearish for everything, the stock market, crypto especially. Again, now if it goes the other way, we go down here, especially if we break the bottom of this multi-year trading range, well, net, that's bullish for gold and crypto. Net doesn't mean absolutely bullish. They must go up. It just means it's a net tailwind for those when you have a falling dollar, because that's what they're priced in. So that causes their, if you free supply and demand, the price to go up. So, all right. Let's see what else I want to cover for you. Seeing some movement, and throughout wheat again recently, like in that. Corn and soybeans are starting to go up. There's CORN, the corn ETF. Look at that, starting to pop this. I'm going to move this line right here. I'm going to borrow that line. Why did I do that? Because I had it a little too high before. This was a previous major reaction low. Come take that line across. You can see we tested it there, bounced, took it out, broke down. If we can build on this breakout today, and it is a breakout right now, we're above the downtrend line, that is what we call a bear trap. Bears, short sellers get sucked in. They start shorting on the breakdown to new lows. Longs capitulate, weekended longs shake out. And then what happens there, two things happen. Short sellers must cover when they see they're wrong. They short here on the breakdown. If it recovers the breakdown, then that's no longer, the whole point for shorting is undone. So their stops are above there. Plus the longs that got shaken out jump back in. So continue to monitor. I can play with this trend line if I want. I look at futures too. I can put the trend line right there just to capture the high of that candle. But that's where I had it. More reactions. We're going to leave it there. Soybeans are starting to move as well. And the reason I bring this up, you know, I've highlighted soybeans, corn, and wheat as, you know, bottoming place for a long time. And have they go nowhere? Soybeans hasn't gone down. It's been moving sideways. And now we have this big basing pattern here, which is my first target back here. We went long somewhere off that divergent low or that breakout. We hit it again. And so before we even got here, if I thought it was resistance, the fact we pulled off it makes me right. And the fact that we hit it again makes me more right. In other words, I'm not trying to say, okay, I'm so right on that. The point being that the more reactions on the level, the more obvious it is to the masses, that resistance level, so the more technically significant it is. And the takeaway is if we can run up there, again, sooner or later, knock, knock, knock. Take a hammer, start knocking on a weak wooden floor. It's going to break through after a while. This is kind of that in reverse. And so, as I like to say, resistance is resistance until unless taken out. But if taken out, I would expect a pretty powerful breakout because, again, the nature of this basing pattern. It's just like the stock market in reverse. When the market was peaking a couple of years ago, we had those tops and SPY, IWM, which I told you I'd get to, and I'm going to roll into the VIX next. IWM was really a big on the daily, the weekly chart here. Pardon all these annotations and lines, but this is IWM from a long-term chart. You're going back to 2009. There's a great bull market in small caps. And what we've done in recent years, again, I know it's a busy chart, so I'm just going to highlight. I have this box right here. This I've covered with you many times in the past and in the last couple of years. We have what was called a double top pattern. 1, 2 distinct and well-separated highs rejected both times. Now, we break out. Solid breakout, especially if the divergences down below get burned through with the indicators going up, taking out the previous lows, then that is nothing but bullish. Or at least I can't spin it anything other than. However, I don't think that's going to happen. I think at best be another marginal new high, potential triple top, because the big divergence is in place and will still be in place if it happens anytime soon. So that's number one. But number two, if we fall back down, and I'm going to zero in on the charts here, you have a double top pattern. You can identify they typically have a base, and that's this box right here. Right here, the base is around, it's the blue box, 165-ish, right? And this is, I didn't invent these patterns. These have been around for a while. You have this measured target. You take the distance from the top to the bottom. Again, this is the bottom of the pattern, the way I see it. You add that, which this line is, to that, and it takes you down. I had this minimum target here even before this double top pattern developed. I created that back in, well, I wrote that down 2025, okay. And so maybe it was already in place, my bad. Oh, wait, no, what did I do that? Yeah, okay, it was already in place. Either way, it coincides. I've had targets on small cap since we first topped. Remember T1, 2, 3 hit, but we went long there, covered. That was my fourth and final target. We reversed because we had positive, aka bullish divergence at that low, went back up and have gone nowhere. The small caps in the last, they peaked back in 2021. They've never been able to take out that high. Now, let's talk about today. So either way, that's the target. It's a 50, I think about a 58% drop from current level, if I'm correct, and that 52. We drill down to the daily chart. I have a series of uptrend lines right here. I have one, well, this was the first minor one. It broke, got a correction. These are similar to the Fibonacci fan lines. I can usually put these up. And quite often I'll see in a strong uptrend, in the beginning you have almost a V recovery and it's strong. So you have a steep uptrend line. That breaks and the next uptrend line sets up. That one breaks and then the final one. And it's usually about that fourth one that does the trick. Either way, this is the current uptrend line. We can make it nice and fat so you can see it. And it comes off the April lows. dancing on it now. If that breaks and we have negative divergence, it's that makes me think, again, you can call it confirmation bias, you can call it what you want. If we didn't have any type of negative divergence, overbought conditions, if I'm not watching Treasuries poised to break out the new multi-year highs, remember rising rates are bearish. They have the biggest impact on the small caps due to their reliance on borrowing. And so all that taken together, now what we need is that catalyst. We need a breakdown there, then take out the 200s, and then I'll turn my focus to the long-term weekly charts. So I just wanted to say the smallies are setting up. I haven't covered them lately. Again, Powell can make or break this depending on what the Fed does, what he says, and we'll see where we go from there. VIX. Okay, so remember I often say the VIX, you've got to be Johnny on the spot. Even short selling in itself can be tough, but the VIX, you really got to get the timing. The VIX will not go up unless the market breaks down. You're never going to see a big rally in the VIX with the stock market going up. This is VIXY. I still maintain that third target. That may be tweaked if and when we get there based on the spot VIX. This is an ETF that does its best, but they have fees and decay expenses and stuff that come out of it. And either way, I still think there'll be another leg up that'll take the VIX to beyond the recent highs. And all I can tell you, we had as I've highlighted, a bullish falling wedge, a breakout. We've been back testing. We're starting to come off that. We still have positive divergence on this daily time frame. We still have the positive divergence on this 60-minute time frame right here. And again, it's the same thing. You can see it breakout, and a back test of this trend line. So let's see what happens tomorrow, next week. The setup is there. And more importantly, as I've said, just this week, late last week and early this week, we've had multiple sell signals in the equity markets and or some market leading Mag 7 or Mag 10 stocks. We still have a few more nearby support levels. And more importantly, guys, probably as important, is we need the financials to break down, because the VIX is based on the S&P, put and call buying on the Standard & Poor's 500. And so you want to see the S&P get hit hard. You want to see both financials and tech go down. It would help if healthcare, the third largest sector, drops too. All right, so that's it. Oh, and then on spot VIX, for insurance right now, for those of you that are carrying a fully long or a heavy long portfolio, net long, the VIX is cheap. And one thing about it, if you get in early, it's you're going to lose money, especially in those ETFs, ETNs. But the VIX remember, the VIX has been making higher lows for months now, even with the stock market making new highs. And this tells you something. That's usually indicative of, a bigger move coming. But where I'm going with that is the downside is limited on the VIX. Not necessarily those VIX ETFs. Unfortunately, you can't buy the spot VIX. But remember, the VIX goes down. This is my weekly chart I just toggled to. The VIX has a floor. And with these two exceptions that were rare, and going back into the 90s, that's where this chart goes, into the 90s, this right here is about the floor on the VIX. So now again, it'll be a dead money or even a losing trade in those ETNs, especially if you go with the leverage versions. But we're coming off this most recent divergent low, and we're still up on there. And we haven't hit my end of bear market targets. We've only hit these last two spikes in the VIX. We gamed them both with near precision, in at the lows, out at the highs. Those were where bull market corrections end, not bear markets. So if there is a bear market coming anytime this year, anytime soon, or even in 2026, this is where the VIX likes to go. This is where the COVID ended, and this is where the financial crisis ended. The rest of this line were just regular run-of-the-mill corrections. So we'll see whether another correction's coming or another bear market. I'm just trying to show the potential that the VIX has when it starts to go. And it tends to go when most traders have given up on shorting and given up on bearish calls and given up on calls for recession, all that other stuff. That's what you need, that fuel for a big drop in the market. I've never seen a big drop come when everybody's short, everybody's bearish. It just usually doesn't happen unless you're halfway through a real acknowledged, verified, bona fide bear market with, you're below the 200s, all that stuff, that last leg down. in the third wave in a bear market. P3 out of a 5-wave cycle is usually the most impulsive, and then you get that fourth wave that takes it even lower. I'm sorry, fifth wave. Fourth wave is a counter trend rally, the last one, and then that P5 down is your final wave. Yeah, that's about it, guys. I don't know. We'll see. You have my thoughts on watch the dollar. I'm watching fixed income closely. I'm watching the this one here, the business development companies. You know, these private credit, which is similar, almost opposite of private equity. It's equity is, you know, ownership, and credit is debt. And this is right on that line. You know, I've been watching and highlighted for you. I think this may be one of the next shoes to drop. Watch this. I'm also watching a lot of other things. I watch a lot of stuff. California bonds. Where's my California bonds? California bonds are looking to break out to multi-year highs in yields, which is multi-year highs in prices, multi-year lows in prices. So this is California Quality Fund. So watch this. Remember, and I pick on California because they're the biggest state in the nation, and they're California's economy is as big as most global economies, other than Germany, the U.S., China, and those. I think that would present larger problems to the rest of the company if. So, anyways, these are things I'm looking out for, and unless they happen, we're right on the line. We're within, like I say, spitting distance of breaking out to new. Not multi-year, but multi-decade highs in Treasury yields, 30-year yields. And there it is. We have a priced in almost a lock, pretty high odds of a rate cut coming up at the next meeting. And look where the 30-year is. It's not reflecting that. Trump screaming Powell to cut. But the bond market, these are the bond vigilantes. They're saying we don't, hey, be careful. Inflation, everyone's written it off and say the Fed won, mission successful, accomplished. The bond market's telling you some other things here, so be careful there. All right, guys, let me wrap it up. This has been Randy Finney with Right Side of the Chart. Have a great day.